Good afternoon, everyone. Welcome to the RBNZ's February Monetary Policy Statement. I'm Anna Bremen, Reserve Bank Governor and Chair of the Monetary Policy Committee. I'm joined today by my fellow committee members, Karen Silk and Paul Conway here on stage. And we have Haley Gorey and Prasanna Gai at the front row, and we have Carl Hansen online. Before we get underway, I would like to thank my MPC colleagues for your constructive engagements over the past 2 weeks, and the Reserve Bank staff for excellent high-quality insights and analysis throughout this process. Over the next 10 minutes, I'll share some slides and I'll talk you through today's decision and our assessment on the inflation outlook. Then I look forward to answering your questions on the monetary policy statement. So today, the committee reached consensus to hold the OCR at 2.25%. The forward OCR path reflects a somewhat stronger economic outlook and balanced risks to inflation. If the economy evolves as expected, monetary policy is likely to remain accommodative for some time. The committee will continue to assess incoming data carefully. As the recovery strengthens and inflation falls sustainably towards the target midpoint, monetary policy settings will gradually normalize. And you can see our new OCR track on the slide compared to the November one. So let me turn to the basis for our decision, starting with inflation. CPI inflation increased to 3.1% in the December quarter of last year. That's the latest data that we have. It's slightly above the MPC target band. We think inflation now, in the first quarter of this year, is likely moving back within the target band. We predict it to be 2.8% in the current quarter and fall back to the 2% midpoint over the next 12 months. If we look into the details on the inflation outcomes and the forecast, we can start by looking at non-tradables inflation. It has been gradually falling since the peak in 22-23, but it was a bit higher than expected in the end of last year. This was in part because of high inflation in administered prices, and these are prices that are set or influenced by central and local government, such as council rates, vehicle licensing, and university fees. When we look forward, we expect non-tradables inflation to fall and administrative price increases to slow. If we turn to tradables inflation, and that's more influenced by global factors, we saw that increases in tradables inflation last year was driven by higher inflation for items with volatile prices, such as airfares, foreign accommodation, and fuel. And that was particularly true for the end of last year. We expect tradables inflation to fall over the next 12 months due to relatively stable import prices, but also some support from the recent appreciation in the New Zealand dollars. And you can note here on this slide how volatile tradables inflation tend to be over time. So in addition to these different ways of looking at inflation, we also look at core inflation. Core inflation measures the persistent component of inflation, and as you can see, it tends to be considerably less volatile than headline inflation. That's on this slide. Core inflation is stable and firmly within our target band. And this is consistent with our forecast for inflation to fall over 2026. So now let's turn to the economic outlook and GDP. Let me start by acknowledging that the past few years have been very tough on many New Zealanders, both household and businesses. Growth has been weak, almost flat over the past few years, and inflation has been high. The recovery is still at an early stage, and there are differences in growth across regions and across different sectors. In the agricultural sector in regional New Zealand, growth has been strong and it remains strong given ongoing strength in commodity prices. We expect growth to continue in those sectors, but also broaden across the economy. So we're seeing now that residential and business investments are increasing. Households, however, remain cautious in their spending, and house price growth remains weak. But we do project that household consumption will increase as past reduction in the OCR continue to support demand, and conditions in the labor market will be improving. So let's turn to the labor market. So even though the economy is recovering, sorry, I'm being a bit fast. What we're seeing in the labor market is that the labor market is stabilizing, but unemployment remains high. We expect unemployment to fall as the recovery strengthens. Employment is actually already growing, but more people are entering the labor force. And this is a good sign, because that's usually what you see at the beginning of a recovery. Wage growth is modest, and that's consistent again with inflation at the midpoint of our target band within the next 12 months. So even though the economy is recovering, there is still significant spare capacity in the economy, and the high unemployment rate is an example of that. So this will continue to put downward pressure on inflation over the coming quarters. So what we're saying is that because we have spare capacity, we expect to see some growth in the economy without inflationary pressures in the near term. So to summarize, the committee is confident inflation will fall to the 2% midpoint over the next 12 months due to this high spare capacity, due to core inflation firmly within our target band, and modest wage growth. In other words, New Zealand's economic fundamentals remain consistent with inflation falling to and remaining at the 2% target over the medium term. Of course, there's always risks to the outlook. The committee assesses that these risks are balanced at the current point. We do see both upside risk to inflation and downside risk. So if we're looking at the upside risk that inflation will be higher than we expect, we see that with demand increasing in the economy, businesses could try to increase prices faster than expected. That's what we mean by price setting behavior on this slide. We see also saying that potential output could remain weak, and that means that increasing economic activity could be more inflationary than we expect. We also see a risk, relatively small, that administered price inflation may not decline as much as we expect. But the risks are balanced, so there's also risk to the downside. So inflation could be lower than we expect. One reason could be that household spending could be slow to pick up, slowing the pace of the economic recovery and then putting downward pressure on inflation. Another thing is that tradables inflation tend to be highly volatile, and it could fall faster than we expect. Finally, maybe a bit optimistically, productivity could improve, enabling the economy to continue to grow with less inflationary pressures. In addition, the global economic outlook remains highly uncertain. So last year, global growth was resilient despite a lot of global risks. We do expect a small moderation in global growth this year in our main trading partners, but there are still a lot of risks out there, and some of them we've listed here on this slide. Risks include global trade policy, the impacts of AI investment, and geopolitical tensions. There's also a risk to growth in China's economy given weak domestic demand, and that could hurt New Zealand's exporters. In the medium and longer term, unsustainable fiscal dynamics in some countries and pressure on central bank independence could also be a cause for concern. So let me summarize. Today, the Monetary Policy Committee decided to leave the OCR on hold at 2.25%. The recovery is gaining strength and broadening across the economy, but there is still spare capacity. The economic fundamentals are consistent with inflation falling to target midpoint over the next 12 months, and the committee is confident that we'll reach our inflation target. Of course, as always, if the outlook for inflation changes, the MPC will adjust our monetary policy stance to ensure that inflation returns to the 2% target midpoint over the medium term.